Bismillahirrahmanirrahim. Today we'll start chapter number 8, that is actually related to accounting for inventory and cost of goods sold. What is actually inventory? Inventory is the term for the goods available for sale and raw material used to produce goods available for sale. Actually, inventory represents one of the most important assets of the business because the turnover of inventory represents one of the primary sources of revenue generation and subsequent earning for the company's shareholders. Inventory is the array of finished goods or goods used in production held by a company. Inventory is classified as a current asset on a company's balance sheet, and it serves as a buffer between manufacturing and order fulfillment. When in turn inventory item is sold, its carry cost transfer to the cost of goods sold category on the income statement. In a merchandise company, inventory consists of all goods owned and held for sale to customers. Inventory is converted into cash into the company's operating cycle, and therefore it is regarded as a current asset. In the balance sheet, inventory is listed immediately after account receivable because it is just one step further removed from conversion into cash and then customers' receivables. Now starting with a discussion of certain terms related in this chapter. So first of all, inventory, as we have discussed, that inventory is the item which is placed on fourth in the balance sheet, and it is actually an amount of goods or raw material or anything which is being furtherly converted. If you have a manufacturing concern, it is being further converted into finished goods and then transferred to retailers or wholesalers for sale. And secondly, if you are a merchandise company, so you have already manufactured goods, so these are present in your shop or at your warehouse for sale. So second term is beginning inventory. So beginning inventory is actually that amount of inventory, whatever your concern is, whether you are a manufacturing concern or you're the merchandising concern, amount of inventory which is present at the start of any period, whether you are discussing an annual basis, so at the start of the year, if you are doing inventory count daily on a daily basis, so at the start of the day what amount of inventory you are there. Third term is your purchases. Purchases is actually any additional inventory which you purchased from outside or from any supplier. So any new purchases are considered as in purchasing, or you can say on manufactured products. Or if you are a merchandise concern, so that means that you have purchased certain items. If you are a manufacturing concern, obviously you are manufacturing that products. So available for sale is equal to beginning inventory plus purchases. So all the amount of inventory which is present at hand in order to sell them, so most that a company can sell during an accounting period are actually categorized as available for sale, and it is actually the combination of beginning inventory and purchases. And ending inventory is actually that inventory which is available at the end of the period. So the same case applies like the beginning inventory, that at ending inventory you have to see that how much amount of inventory is left to be transferred to the next period. And cost of goods sold is the actual cost of all those goods which you have sold in the market, and actually it represents the cost of inventory and cost of that inventory which is being sold. So these are some of the terms which we will discussing, and rapidly we use these terms in the next few There are certain aspects which can affect the purchases of the organization. So we have to add or deduct certain items in order to have an accurate price of purchase of inventory. So when you look at this slide, we can ascertain that the actual purchase or actual value of the inventory was $6 lakh, and we have to add in any type of transportation or delivery charges that are called as freight in or delivery charges that amounted to be 4,000 over here. And after that we have to deduct certain items, first of all, which are your purchase returns. Purchases returns are those items which actually you have returned to your supplier, so or any other body from which you have purchased these items. So it might be possible that there are certain defects in that item, or you don't need that item anymore, or any other aspects, and due to which it is resulted that you have returned certain items to your suppliers. So you have to deduct the amount of those things which you have returned to your suppliers. After that are two items which are purchase allowances and purchase discounts. Purchase allowances are actually allowance or actually any allowance which is being offered by the supplier which has given to you, and obviously discount is same kind of thing, whether you have made payment earlier. So in that case they have given you discounts. So all these items have to be deducted. Only the freight charges have to be added into your purchase price of the inventory. So in this case, if we look into this, they have added freight charges that are of 4,000. After that they have deducted 25,000, 5,000 and 14,000. All of them are deducted. 25,000 are of purchase returns. Purchase allowances amounted to 5,000, and purchase discounts amounted to 14,000. So now the current price of the current value of purchases is 5,60,000, and we have to add these purchases to our beginning inventory in order to get the cost of good available for sale. So after determining the actual price of purchases or the total cost of purchases, the second important calculation regarding inventory is that you have to determine the cost of goods sold and cost of ending inventory, because cost of goods sold should be transferred to the income statement. So it's very important to determine the actual amount of cost of goods sold and the amount of ending inventory. So in order to calculate the amount of cost of goods sold, first of all you have to determine the cost of beginning inventory. You have to then, after that, you have to add any amount, the all total amount of purchases or the total cost of purchases. This will give you the cost of goods available for sale. After deducting cost of ending inventory, you can deduct, or you can calculate the amount of cost of goods sold. In case of cost of ending inventory, the same case, you have to add cost of purchases with the cost of beginning inventory, so you will get the amount of cost of goods available for sale. And if you deduct amount of cost of goods sold, you will get the cost of ending inventory. Now see this example. In this example, we have inventory on January 1st is 20,000. This is actually being written as beginning inventory. Then after that, purchases during the month was 26,000, and inventory at the end of January, that is 31st January 2019, is 18,000, and this is actually ending inventory. So what we have to do is we have to find the cost of goods sold. So as we have said, we have seen that cost of beginning inventory is 20,000, and we'll add 26,000 cost of purchases. So you have to also ascertain that this cost of purchases include the delivery cost of the purchases. Secondly, we have deducted any allowances, discounts, and any other thing which should be deducted, or for example, purchase returns are also deducted, and this is actually total cost of purchases, which is actually adjusted cost of purchases. So by adding both of them, we'll get cost of goods available for sale. After that, we have deducted the ending value of inventory, that is 18,000, and this is the amount of inventory which is left after the completion and doing all the activities in January. So this is the amount of inventory which is actually going forward in the February. So this is the 18,000 value of ending inventory. We have deducted this an amount of inventory from the cost of goods available for sale. After that, we'll get cost of goods sold. Okay, now if we want, for example, over here it is written that find the cost of goods sold. So if this value is given, cost of goods sold is present and ending inventory is missing, so we can easily adjust the same procedure and we can get the value of ending inventory. So, what is the difference between this slide will tell us about the difference between inventory and cost of goods sold. So whenever we are actually making conversion and converting the inventory into cost of goods sold, so when the inventory is actually converted into goods and after these goods are being sold, so in that kind of case, the amount of inventory which is being sold is transferred to cost of goods sold. So an inventory is sold and we remove its cost from the asset side and insert its cost into the expense on the equity side. This property exists for all assets. As they are used up or sold, the costs transfer from the balance sheet as future economic resource to the income statement as an expense incurred to generate revenue. So actually, in this case, what we are doing is that as we have converted our inventory into cost of goods sold. So once this conversion is done, so this inventory is no more available in the balance sheet. Therefore, what we do is we convert that amount of inventory into cost of goods sold. So just like the matching principle, that we have to match expense with the revenue. So once this inventory is converted into expense, so after that it will be deducted from the sales and we'll match the revenues and expenses. As we are discussing inventory, so what is the relationship between balance sheet and income statement related to inventory? So when we look at income statement items, so in income statement, it's actually we see revenues and expenses and gross profit and all those things. So when we see that sales revenue is actually the sale price of inventory sold, because what we are selling is the actual inventory, which is actually goods which are being sold to the people. So sales revenue is the sale price of the inventory which is being sold in the market, and cost of goods sold is the actual cost of that inventory that is sold in the market. And gross profit is actually the deduction of cost of goods sold from sales revenue. So actually it is the profit which tells that after deducting the actual cost of that total items, what profit we have gained, and after that we'll deduct further items and taxes and interest and all those things, and we will get a net income. But in case of balance sheet, inventory on the balance sheet is based on the cost. We always write the actual cost of inventory on the balance sheet item. So this is the difference between the income statement and balance sheet approach in case of inventories. This slide shows that how inventory is valued in balance sheet and how the cost of goods sold is valued on income statement. In balance sheet, the inventory, because when balance sheet shows the point in time figures, and it is the statement which shows the amount of asset, liabilities and owner equity at any specific date. So at that time we see that how much number of units of inventory are on hand and what is the cost of those units, depending upon that what type of methods of costing we are using. So we multiply the number of units on hand of the inventory and the cost of the acquiring this inventory and the total cost of that inventory, and that amount is written on the balance sheet. On the other hand, the cost of goods sold, which is the item of your income statement, It shows the number of units of inventory which is sold multiplied by the cost per unit of that inventory. So we multiply these figures, and in this case we'll get the figure of cost of good sold. There are actually two main systems of recording the inventory in accounting system, and different the type of business use different type of inventory systems, or it might be possible that same business are adopting different kind of inventory system for different kind of items. But whatever the case is, we have two basic system of recording the inventory. First one is periodic inventory system, and the second one is perpetual inventory system, recording system. So when we talk about periodic system, so as the name suggests that there is certain period associated with this system, so it does not record it does not keep a running record of all the goods which are being sold or purchased and all those things. So they actually update the amount of inventory after a certain period, and at least, and when we talk about gap principles, so in case of a periodic inventory system, we have to at least take a physical count of, or keep record of the inventory items if we are following periodic system once a year. So majority of time this type of system is being used for those items which are not very expensive, and you just want to keep the record of those items. But on the other hand, we have another type of system that is called as perpetual inventory system. This system, as compared to the periodic system, is like that we have to keep record of the item which is being sold or which is being purchased, and we have to keep running record of all the goods and sold and brought and sold if we are following the perpetual inventory system. But at least we have to take once a year, and it can perpetual inventory system can be used for different item, but majority of time we will use this system. We use this system in case of expensive items, in case of the items which are very crucial for the organization, which are very strategical nature of the nature of the products. So in this case we have to take perpetual inventory system. We have to follow perpetual inventory system. As we know that starting every transaction start with the entry in the journal. So how you will record the purchase of inventory when we are recording the information of the purchase of inventory in your journal. So when we purchase anything, any asset, so it is always debit. So the inventory is debited. Over here we have purchased inventory of 5,60,000. So this amount is debited, and accounts payable is credited because this purchase is on credit. So this is the real entry of your purchase of inventory, and this purchase is on account. On the other hand, the second step is that we after purchase of that inventory and after recording that information into the journal, the then information is transferred to the ledgers. So in the ledger, if we see the ledger of inventory and a ledger of accounts payable, so the beginning inventory is 1 lakh and the new purchase is 5,60,000. So this is 5,60,000 is added into the debit side of inventory of the T account, and there is no previous account payable in this T account. So this amount of accounts payable is transferred to the T account of accounts payable, and this is 5,60,000. First transaction which we have discussed was that how we will record the purchase of inventory in our journal and in T accounts. But on the other hand, we have another transaction which is associated with inventories, that is sales. And also after you have done the sale, you have to record that how much cost that was actually the cost was of that sale. So in that case, first entry would be of credit sale, And as we know that increase in sales or revenue is always recorded as credit, so this sale is recorded, the amount of the sale or revenue is recorded on the credit side of the journal. On the other hand, it is actually credit sale. So credit sale has generated account receivable of 9 lakh. So first we'll record that transaction. After that, the other transaction is associated with recognition of the cost of goods sold, that actually we have done the sale of 9 lakh, but there is amount of profit also associated with that. There is also amount of added, that because in the previous lecture, previous slides, we have seen that the sale, the total amount of sale is the amount of inventory which is being sold multiplied by its sale price. So in the sale price we have also the profit added into it. So in this case we have to recognize that what is the actual amount of cost of goods sold is, and we have to recognize it, and we have to transfer that amount of cost of goods sold from the inventory to the cost of goods sold section. So the first transaction would be that we have to record the credit sale, that is the account receivable was debited with 9 lakh, and the sales revenue is credited with 9 lakh. So is this we record that it is actually the sale. After that, the other transaction would be to record the cost of goods sold, because in this transaction they have already recognized that the actual cost of your sale was 5,40,000. So this is the cost of the inventory. So we have to transfer that cost from this inventory to the cost of goods sold section. So we record this as, so we have recorded this in the credit side of inventory, and by recording this on the credit side, if we look into the T account of this, so the amount of 5,40,000 has transferred from the inventory to the cost of goods sold. So it is transferred to the credit side of inventory. So now this amount is deducted from the actual amount of your inventory, and now the inventory amount is decreased. This is the T account of the previous transaction, and if we look into this T account, the beginning inventory was 1 lakh. We have added the purchases of 5,60,000. After that, this 5,40,000 is the outcome of the sales the sales we have done, and this is the cost of that sales. So it is transferred over here. So after that, the net amount of inventory is 1,20,000. Moreover, we have also added the amount of cost of goods sold to this T account. So now this amount is transferred to this cost of goods sold section. Now, how all these item is represented in the financial statement? As we have discussed that the inventory is the balance sheet item, and when we write inventory, we have to see that how much inventory is on hand and multiply the multiply it with the actual cost each unit of this inventory. Now, how these inventory and cost of goods sold are reported in the in financial statement? Basically, we have two financial statement. One is your income statement, and the other one is your balance sheet. And if you remember, we have discussed in the accounting cycle that once we record information into the journal, and after that are being transferred to the ledger, then we have to prepare trial balance, and after preparation of trial balance, we have to make adjusting entries, and after making adjusting entries, we have to prepare adjusted trial balance, and after adjusted trial balance, we have to prepare a financial statement. So an income statement is the statement which actually shows the amount of sales we have done, and how much profit and how much is the outcome of is from our operations. So if we see the partial income statement of this company, the sales revenues are 9 lakh. This is the previous transaction which we have already done in the previous slides, and the cost of goods sold for incurring this or sort of generating this sale is 5,40,000. And when we deduct 5,40,000 from 9 lakh, we will get 3,60,000, which is the gross profit of the company. Whereas when we see the balance sheet, the which is also a partial balance sheet, and we already know that inventory comes fourth in the balance sheet. So this is the amount of inventory, and it is 1,20,000. And if you remember, we have deducted the cost of goods sold amount from this inventory. Now the inventory amount is 1,40,000, 1,20,000 at this. Another issue related to inventory is inventory costing. Inventory costing is actually a method in which we will determine that what cost which we should assign to each items which are being sold. So sum of all costs incurred to bring asset to its intended use. So the methods for determining per unit cost of inventory. So there are basically four methods which can be used to specify the cost for this for identifying the inventory cost. So the first one is specific unit cost, secondly average cost method, third one is first in first out method, and last one is last in first out costing method. It's simply this that at the end of the period, when we are ascertaining that how much cost should be incurred into the cost of goods sold and how much cost should be entered into the entering inventory. So in this case, as we have certain items, and due to changing in different conditions, the prices of different item increase or decrease. At certain times we have certain items already available in our stock, and we buy more of them at higher or lower prices, so there would be a difference in the per unit cost. So at the time when we are determining the ending inventory amount and the cost of goods sold, at that time we have to determine that what type of what type of the amount of cost should be assigned to different units. So there are four methods which can be used to determine the actual cost we should assign to our inventory. So we will discuss with example one by one of this method. Before discussing the methods which you should use or different types of method, we should keep in mind that these are the managerial decision. These are not actually the actual inventory movements. It depends upon the decision of the management that what type of what amount of inventory should amount of cost should be assigned to inventory, and what amount of should be assigned to cost of goods sold. So it's not based on the actual inventory movement. It's actually a management tool in order to manage our earnings and to decrease the effects of taxes, because at the end of the period every company has to pay taxes, and in order to minimize their tax burdens, certain tools can be used. So this can be used as a tool in order to avoid higher taxes. So it's managerial tool, not an actual movement. Before starting with the method, we have to see the data which being used in giving explaining the each and every method of inventory costing. So at the first we see that there is a beginning inventory, and at the beginning inventory we have 10 units, and you have purchased these 10 units at the cost of $10, and by multiplying both of them we'll get $100. And the number one purchase is 25 units, which would be purchased at a cost of 14 per units, and that their total cost is 3,350. The second purchase is of 25 units that have purchased at the price of 18 per unit, and their total cost is 450. And these total purchases are amounted to 800. So the cost of goods available for sale are $900. And in the ending inventory we have 20 units, and the cost of goods sold is 40 units. So now the purpose, our main purpose is that how much cost which we should assign to ending inventory of 20 units, and how much cost should be assigned to the cost of goods sold. So this is the main aim or main emphasis of these four methods. The first costing method is a specific unit cost, and this method actually identified that what was the price of specific units and what unit has sold. So you have to certain that, and after that you have to assign that cost to that. So for example, we have 20 units in ending inventory, 40 units in cost of goods sold. So you have to ascertain that how much of units have a cost of actual cost of 10, 14 or $18, and by ascertaining that, you can multiply that units with that cost, and then you can forward it to ending inventory or cost of goods sold. In the case of your question, this thing would be specifically specified in your question, so you don't have to worry about that. You have to find out the specific cost of certain units. So they'll tell you that which the unit sold, or the unit per unit sold, or the units which are being are in the ending inventory, and when they were purchased and what was their specific cost. So in this case, we have in ending inventory we have 10 units from the purchase of $10, 5 from $14, and 5 from $18. So multiplying it and adding it, we'll get the total inventory cost of 260. In case of cost of goods sold, 20 units were sold, or which were purchased at the dollar of 14, 20 were of dollar 18, and 20 were dollar, and the total cost was the cost of goods sold was 640. The second method is average cost method, and in average cost method we have to first determine the average cost, and the average cost can be determined by dividing the cost of goods available divided by number of units available. Cost of good available come from the combination or the addition of purchases and the amount of beginning inventory and the number of units available. As the question suggests that the total value of cost of good available is 900, and almost there are 60 units available. So 900 divided by 60, so we'll get the 15 unit cost, which is which you can see over here. So this is your at the ending inventory we have 20 units at the average cost of 15 per units. So that is actually this 15 is determined by 900 total cost divided by 60 unit, that is equal to $15 per units. And the ending inventory is you have 20 units, so we multiply 20 by 15, so we will get 300. And in cost of goods sold we have 40 units, and the average cost is $15, so we multiply 15 by 40, so you will get 600. So in the ending inventory we have $300, and in cost of goods sold we have 600. The third method is called is FIFO. FIFO stand for first in, first out, and first in, first out suggests that we have to assign the oldest cost to the units. First we have to assign that, and after that we'll assign the latest cost. So first cost into inventory are first cost assigned to the cost of good sold. So this is called as FIFO. So in this case, as we already know that we have 20 units in our ending inventory, and we have 40 units in cost of goods sold. So when we are ascertaining ending inventory, so $18 were the last cost, so these are assigned to the ending inventory. But in the cost of goods sold, because these first in first out you have then suggest that we have to assign the oldest cost to the cost of goods sold. So the first cost was a dollar 10. So 10 units at the rate of $10, then 25 units at the rate of $14, and 5 units at the rate of $18. So 540 is the total cost of goods sold, and 360 is the value of ending inventory. So in this case we have assigned the latest cost to the ending inventory and the oldest cost to the cost of goods sold. LIFO is the fourth inventory costing method, and it is actually opposite of FIFO. It stands for last in, first out. In case of FIFO, we have assigned the latest cost to ending inventory and the oldest cost to cost of goods sold. In this case, there is opposite case. We will assign the latest cost to the cost of goods sold, and the and the oldest cost would be assigned to your ending inventory. So as we know that we have 20 units in ending inventory, and we have 40 units in cost of goods sold. So the latest 25 units which we have brought at the cost of 18, and the 15 after that, so these are the latest costs which are assigned to cost of goods sold, and the total cost cost of goods sold value is 660. On the other hand, the oldest cost would be assigned to the ending inventory. So these 10 units were at the cost of $14, that is 140, and 10 units at the rate of 10, that is 100. So 240 is the value of ending inventory, and 660 is the value of cost of goods sold.